Debt to income ratio. You've heard of it, but you're not entirely sure what it is or how to calculate it. No problem. Stay tuned to the video because we're going to break it down. Hello, welcome back to my channel, BB Knows. I am Brandy.Baker and I am a realtor here in Michigan, here to share with you all that I know about real estate and how exciting it is. So if you haven't already, like and subscribe right below, and then you can hit the little bell so that you know when I put new videos out. If you have any questions or any topics you'd like me to cover, please feel free to put them in the comment section below or send me an email, reach out to me, however you feel best communicating. I would love to hear from you. Okay, let's get started. So, calculation that we're using is going to be your monthly debt divided by your gross monthly income. And the gross monthly income is going to be all of the money that you make before taxes are taken out. Nice. So, monthly debt, what is that? That is going to be everything that you pay each month. So, if you have any credit card debt, a car loan perhaps, your insurance, any phone bill, cable, or internet service providers that you pay. Perhaps you have another mortgage on a rental property, or you're just looking to move and you haven't fully paid off your home that you're living in. All of that goes into your monthly debt, and yes, unfortunately, student loans are calculated into your monthly debt as long as you're paying on them. So if they're in forbearance because you're still in school, you're good. But if you're paying on them each month, they go into it. And for your credit cards, if you're paying over the minimum amount due each month, which is a great idea, that's fine. However, you only need to calculate the minimum amount due. So if you pay $100, but you only have to pay $25, you're going to use the $25. Okay? So let's take an example here. Let's say you earn $48,000 a year. We're going to take that $48,000 divided by 12 months. We're coming down to $4,000 gross monthly income a month. We're not going to worry about the taxes being taken out because that's the number we get to use. Also, if you have a spouse, you can use both your gross monthly incomes or if you have another person that you're buying the house with, you guys can combine your incomes. You also have to combine your debts. So keep that in mind. But hey, combining incomes is always nice. So I've heard. Anyway, the $48,000 annually divided by the 12 months gives us $4,000 a month. And I'm going to use credit card debt of $200 a month. Phone bill is $75 a month. Car loan is $300 a month. And student loans of $200 a month. And your fund gym membership is $25 a month. That gives us $800 that we pay out each month for living expenses. Now we take that $800 divided by $4,000 of gross monthly income, and you're going to get 20%. So your current debt to income ratio is 20%. Good job. That's a good debt to income ratio to start with. Now, let's say you are looking for your home and you think, I can probably afford $1,000 a month for my mortgage with everything rolled in, and we'll go into that in another video. But $1,000 a month for my mortgage payment each month. We now have $1,800, which will be our new which will be our new monthly debt. So take that $1,800, and divide it by 4,000. You're going to get 45%, which is your new debt to income ratio. So when the bank is trying to decide on how much money to lend you, or if you're able to lend, the 45%, that's the number that they're going to be using. If they think that the home that you purchased would qualify you for a $2,000 mortgage, and that sends your debt to income ratio over 45%, they're not going to give you that loan. They're going to only loan you enough money so that your new debt to income ratio with the mortgage included does not exceed 45%. That's pretty much the max across the board for FHA for sure. Typically, yes, for conventional. The USDA loan has fewer restrictions, and so does the VA loan have fewer restrictions on debt to income. It's so long as you have other great credit history. So that is our breakdown for the debt to income ratio. As a side note, I do want to clarify, because I get this question quite a bit from my clients when we're starting to look for homes, is what does $1,000 a month actually buy me? Like, how much of a loan will I get to pay only $1,000 a month for my mortgage? And I need to let you know that that depends on so many different factors. It depends on, are you rolling your taxes into your annual taxes? Are you rolling those into your mortgage payments? How much money did you put down? Because are you paying mortgage insurance premiums? Are you doing a 15-year fixed rate? Are you doing a 30-year fixed rate? So many different factors. And you can leave in the comments below if you want me to break that information down for you as well. But I was just using that $1,000 payment for the example that we had. And I want you guys to know that there's so many different factors that can change that number. In essence, right now, I could probably tell you that $1,000 mortgage might qualify you to probably about $125,000 to maybe $150,000 on a loan, depending, again, what kind of loan you have, how long is that loan for, what is the interest rate, what are the taxes in the area. So I guess that wasn't super specific, but there you have it. Okay, guys, thanks for checking out my video. I'm so glad you now have a better understanding of the debt to income ratio and how it's calculated. If you have any other questions, feel free to reach out to me. I am more than happy to share with you all that I know. You can leave your questions in the comment section below or hit me up in my info over here. And don't forget to like and subscribe and share this video with your friends so that everyone can have a great understanding. Other than that, enjoy the rest of your day, and I'll see you guys next time.